Good day, everyone, and welcome to Compass Conversation, GSE Recap and Release. At this time, all participants are in a listen-only mode. Later, you'll have the opportunity to ask questions during the question and answer session. You may register to ask a question over the phone at any time by pressing the star and 1 on your telephone keypad. Please note this call may be recorded and we will be standing by if you should need any assistance. It is now my pleasure to turn today's conference over to your Head of Financial Policy, Ed Groshans.
Good afternoon, all, and thank you for joining me. I'm Ed Groshans, Senior Policy and Research Analyst at Compass Point. I am pleased to have Tim Pagliara and Grant Stark to join me to discuss the outlook for recapitalizing and releasing Fannie Mae and Freddie Mac. Tim is the founder, chairman, and chief investment officer at CapWealth. Tim founded CapWealth in 2000 with the mission of delivering financial services rooted in transparency and integrity. CapWealth is an independent SEC-registered investment advisory firm based in Franklin, Tennessee, with nearly $1.7 billion in assets under management. Over his 30-plus years in the financial services industry, Tim has pioneered approaches such as sophisticated simplicity and improvable integrity, which emphasize clear, honest practices to benefit clients. Tim has also made headlines as a vocal advocate for Fannie Mae and Freddie Mac shareholders. Since 2014, he has championed their rights through Investors Unite, an organization he founded to seek justice and restitution for shareholders impacted by the U.S. Treasury Department's conservatorship of these entities. In his book, Another Big Lie, Tim reveals the untold story behind the government's handling of Fannie Mae and Freddie Mac. He uncovers a series of crimes and cover-ups that resulted in what has been called the largest financial heist in U.S. history, a story of corruption that undermined the American dream of homeownership. Tim earned his undergraduate degree at St. Louis University and a law degree from St. Louis University School of Law. He also graduated from the Wharton School Securities Industry Institute at the University of Pennsylvania and is a Tennessee Bar Association member. Grant Stark, CFA, is a partner and the Director of Research at CapWealth, where he collaborates closely with Tim to co-manage the firm's investment strategies. With 17 years of experience, Grant specializes in value investing, distressed assets, and special situation securities. Prior to joining CapWealth, Grant spent nearly a decade at Fairholme Capital Management, where he contributed in-depth analysis and strategy development for major investments, including Fannie Mae, Freddie Mac, and American International Group. His expertise in these areas has been a cornerstone of his career. Grant holds a bachelor's degree with distinction in finance from the University of Miami and is a CFA charter holder. He is also a co-founder of the Miami chapter of the American Enterprise Institute's Enterprise Club. Grant currently resides in Franklin, Tennessee. Tim and Grant, thank you for joining me today. Tim, let's start with your view on the GSEs following the election of Donald Trump to be the next president.
Well, thank you very much, Ed, and thank you, Compass Point, for giving us this opportunity to speak with everyone today. I'll start just with kind of a full disclosure of how long we've been involved in this trade and various different aspects of it, but we've actually been involved in the trade since 2008. Grant joined me in 2020 after a great education and a lot of experience at Fairholme Capital. And so, we are shareholders individually, our families, our firm. And so when we ask who are we advocating for, well, we're advocating for shareholders, but this whole issue has evolved. We also believe that we've reached this moment where the shareholders' interest, the taxpayers' interests, the entities themselves, the cost of conservatorship, and what it is doing to continue the housing finance crisis and the housing crisis in America, we're all aligned towards coming up with solutions. And that advocacy that we've involved ourselves in has taken created a lot of different opportunities, and we've done a lot of it behind the scenes. We were the sponsor behind the Brookings event in 2022, and we've engaged positive dialogue for solutions during that entire period. In fact, in October of 2023, we hosted Sandra Thompson in Franklin, Tennessee, in which we gathered all the stakeholders that have an interest in workforce housing and the problems that are associated with housing supply and increasing housing supply in Franklin. And it was a very great opportunity for Director Thompson to listen, and she took back a lot of great information just from that. So, Ed, I wanted to, compliment you guys on the report that you did. And what I thought I would do is just add a little to what we know about what we think the trajectory of this will be following Trump's reelection and how we think that 2025 could evolve and what could happen. And so in order to do that, you've got to deal with the different aspects of this trade and what it will take to exit conservatorship. You've got liquidation preference. We've got the issue of the senior preferreds. We've got warrants. We've got junior preferreds. The government owns, through the warrants, 80% of these entities, and the individual shareholders, existing shareholders, own 20%. So let's unpack that a little bit and lay it out in a sequence and how we think the Trump administration will react and how this could potentially go in 2025. The first thing, to address is this whole concept of liquidation preference. Even the Congressional Budget Office really doesn't deal with the liquidation preference. It's an off-balance sheet item. It's not integrated into the accounting of these entities. And so it's the easiest thing to make go away. When you talk to people in FHFA and people that are in these companies, the liquidation preference, the concept of it was set up to protect the government in the event that the mortgage crisis got worse or there was some reversal in the quality of these entities. And so it's the easiest thing to write off because it accounts for nothing at this point. And then I'll move real quickly to the senior preferreds. There is a lot of talk about whether they can be written down or not. And I think the key operative is, if they were written down, what impact does that have on the current deficit to the Treasury? And the answer is none. We've confirmed that inside FHFA. We've confirmed it with the lawyers. We've confirmed it with other people that are close to the investment banking side of this. And so then it just becomes a question of, can Treasury legally write down the senior preferreds? There's some controversy with this, but at the end of the day, the attorneys tell me that this could very easily be settled, and all the litigation could be settled with the write-down of the senior preferreds, not in a compromise of claim, but in a global settlement to get them out of conservatorship. And so that's a key factor. And the thing that you need to understand about the senior preferreds, writing them down does not create capital or add or detract from capital. Writing them down or converting them to common doesn't create capital. What it does is it improves the financial outlook of the companies. It improves their balance sheet because it's eliminating an obligation and an unknown obligation. So that actually is a key component of this, because as you know from your previous call and what you put in the report, the optionality that exists today compared to 2020 when the CBO looked at this the last time, there's over 200 different scenarios that they're considering. I think just a little over, less than 10% of those scenarios were viable in 2020. 60% of those scenarios are viable now. And when you look at this process of reconciliation that we're talking about, where you would put the GSEs into reconciliation, the objective there is obviously for the government to monetize their interest in these warrants at the highest level that they could, possible. So that would be one of the things that I believe the investment bankers, Treasury, everybody will get together on. They'll declare these as paid, and they should be written down. And that's actually the right thing to do, and it would settle all of the litigation almost immediately. The other tangible benefit that that would have is that it will eliminate the need for raising as much capital, and it would move the entities out of conservatorship quicker. You know, one of the problems with housing finance right now is that these entities have two hands behind their back because of conservatorship. There are things they could do as publicly traded companies that they cannot do now. For example, one of the problems is construction to permanent financing, mezzanine financing. We believe that Fannie Mae has the authority to do that now under their charters. It may require an amendment to Freddie Mac's charter, but being able for a new homeowner to sit down with a quality builder at the table, plan out a home, set a 9-month target for building that home, and to be able to go from construction to permanent financing all packaged, that would get a lot of the competition and a lot of the contracts that are being written on the hoods of cars right now. It'd get it back into a more organized fashion, and it would gradually improve and increase the amount of housing that's available. And that's the problem right now. It's the shortage. One of the proposals that's being kicked around in the utility model would earmark some of the proceeds, which now is estimated to be somewhere between $150 and $200 billion from the government's warrants and conversion into common and the sale of that common, that there would be that money, a portion of that money could be used for mezzanine financing to jumpstart housing till we catch up with this backlog, and then the money would revert back to the government for general purposes. But it's real important to note and to understand, again, when we're focusing on what's new with Trump, there's a move towards privatization. There's a move to decentralizing these bureaucracies, and they've got to have pay-fors. You know, they're going to have things that they want to do in their agenda. They've got to be able to pay for them, and the $150 billion to $200 billion in Fannie and Freddie is a lot of low-hanging fruit that they can get very, very easily. So, you know, now I'll touch on the junior preferreds, and I know, Ed, in your proposal, you had that as kind of a takeout. And one of the easiest things to do in recapitalization and release, and I would say this is as close to a consensus as anything that I've heard in the discussions that I had. The easiest thing for Treasury, FHFA, and the entities to do is agree just to turn the dividends back on the preferreds. If you look at the $35 billion capital stack, they need preferreds in the capital stack. It is CET1 capital that they would have to replace if they paid it off. At 7%, the way it's designed, it actually presents a pretty diversified pool of preferred given current interest rates. And again, it would require no shareholder vote. It would require, you know, something that, again, the lawyers have told me, the litigation, these issues could be settled in 2 weeks under the right circumstances. And so, you know, it's really not in anyone's interest to do anything but keep that $35 billion in the capital stack. Otherwise, every dollar that they reduce it by, they've got to go out and raise another dollar of capital. So before I turn it over to Grant to talk a little bit about the valuation models that we put together in the different scenarios, I'll leave you with this point. I don't believe that this is going to take 2 or 3 years. And let me define what I mean by that. I believe that through an executive order, a Treasury that is focused on getting this done in privatization, the need for the Trump administration to move quickly and deal with these lingering problems, that by the end of 2025, these entities could be relisted, the reprivatization could start, they could be operating under a memorandum of understandings, for whatever capital that they need that they could accumulate over a 2-year period, pay a dividend on the common, pay dividends on the preferreds, and bring the offering back out at a very, very reasonable valuation, maybe 8-9 times earnings, and then the government would sell into the success that these entities would create over the next couple of years, and they would have, their interest completely out, and they'd be out of conservatorship. And this has been going on too long. You can study things forever. There's a lot of just bad data out there, bad opinions. Everybody's entitled to an opinion. Everybody's not entitled to their own set of facts. These entities are very strong. They've got an average of a 755 credit score, and right at about 60% loan to value. So, they're strong. There's no need to put them on the balance sheet of the Treasury. That was the whole purpose of having this public-private partnership in the first place. And I think the outlook is very positive given the dynamics of what the Trump administration wants to accomplish. So, Grant, why don't you pick it up from there?
Yeah, thanks, Tim. And so before I really dive into any of the numbers, I do want to lay a couple ground rules in how we've looked at modeling. And I think some of these soft items are just as critical as some of the numbers. The first one to me is, after having studied this for 15 years, the ideological biases that existed 10 to 12 years ago politically have largely been mitigated and are out of the conversation now. And I think that's a critical component because a lot of what we've been modeling for 10 years that made sense then still makes sense today. The difference is the companies are much healthier. The consensus is that we don't need to blow them up and we don't need to disrupt the larger housing finance ecosystem. Fannie and Freddie are the best solution for our 30-year fixed rate mortgage environment as we have it today. And so that setting the stage as that is sort of the operating environment today. I would say numbers also matter. So the two headline are the GSEs were essentially, if you want to call it a loan, they were loaned out about $192 billion over the life of the conservatorship. And they have repaid in dividends, according to the CBO, about $301 billion. So you can do a lot of math behind that and say, what's the effective IRR over that time period? Largely speaking, the consensus now remains that they have been repaid for the risk that taxpayers took. And this has been a wildly successful program if you comp it even against the TARP programs like AIG and some of the other banks. So that's step two. They're already in a sort of a good place with Treasury and taxpayer repayments. We're not digging out of a hole as far as what they've been lent. And then now you look at going forward. So let's look combined first. The book value, if you set aside the liquidation preference for a moment and you just look at the book value of combined Fannie and Freddie, it sits at about $140 billion. And I'm going to focus just on Fannie Mae. I think it's a little bit simpler to focus on one of the entities because as one entity will do, the other will follow. And so for this year, we're estimating between 12 and 13 billion of net income that can be generated at Fannie Mae. And so you're going to be adding that on to its capital annually. One of the changes that was made in the last amendment was that the GSEs are able to retain their earnings right now. and that liquidation preference just grows. So it's sort of a plug number, as Tim had mentioned. And also important, Fannie Mae's net worth right now, that book value component, of that 140 total, they're about 90 billion right now. So Fannie's sitting with a fairly good book value. And one of the key components that Tim mentioned is the next assumption in modeling this really does come down to what do you do with those senior preferreds. And our operating assumption is, for the most part, that they can be eliminated, and the government would be incentivized to eliminate these. In most scenarios, when you model this, there is just marginal improvements in the outcome for the government and the Treasury Department, whether they convert those or not. Because if you just take this step by step, the warrants for 79.9% of the company would be exercised in any scenario. So the government would then own that 79.9%. But then if the senior preferreds were converted, you are massively diluting Treasury's own stake. And so the best outcome, and why that matters is they understand, the Treasury understands, FHFA understands, everybody we've spoken to understands that there is a commercial element to the eventual outcome of this conservatorship. Just like the TARP programs, like AIG, the government doesn't want to be in the business of owning Fannie and Freddie, and they want to eventually be able to exit these positions. And to be able to exit these positions, they have to make it a realistic commercial return on capital and return on equity and valuation. And they essentially shoot themselves in the foot by diluting to own 99-point-something% of the business. So that's going to be our operating assumption. So then the next step is the last amendments to the capital requirements. We're going to look at just Tier 1 capital. 4.5% is the current target. Now, even CBO would say that is, if they could, they would likely say that's very onerous. If you have one takeaway today is you could lower that Tier 1 capital standard to around 2.5% in Fannie Mae, and anything that happened in 2008, and in fact, in much worse scenarios, they would be covered by their own capital if you can get them to 2.5%. In some scenarios, they're actually covered by 2 or 3 to 4 times what would have happened around 2008. So we think one of the more realistic outcomes is there will be some revision of those capital standards to a more realistic commercial level, which is roughly around 2.5%. It doesn't have to be right there, but it certainly 4.5% is high. I will also point you to a CBO report that it was originally released in 2020, and it was revised December of this year. They say in their revision that modest capital requirements of 3% with a expected investor return on capital of 8% would generate $205 billion in the exercise of the warrants for the Treasury Department. So remember what I said in the beginning too. They've already taken in $300 billion. So net out that they've already taken in essentially $100 billion more than they lent. They could stand to gain at least $200 billion more. That's right from the CBO, and that corroborates everything we've modeled. You know, before they came out with this, we have been screaming from the mountaintops that they have this tremendous value with the warrant, and it makes sense for them to exercise. Now, I'll briefly discuss some of these scenarios that could occur. I would say that the scenario that is a little bit less likely, in our opinion, is if you convert that senior preferred to common and dilute the warrant and every other common shareholder. This is where the nuance of sort of pick your side if you want to be in a preferred stock or the common stock today. If those are converted, you're looking at maybe $1 to $1.50 per share of value at an 8 times price to earnings multiple. Just the tremendous amount of share dilution at these lower levels really makes it difficult to eke out larger PEs and eke out larger per share numbers. So if you're a common holder today, you're really stuck in this range. Now, a common holder today, if the senior preferred were to be written down, that could be in the $10 to $15 per share range on the common stock. That is simply some modest capital raises along the road of maybe $10 to $30 billion if the capital requirements for Tier 1 were lowered by 100 basis points, and you allow them to build up capital for another couple of years. My final point, and I will pause for Ed's comments, is when you're looking at these models, another point to really consider is in any scenario where we're looking at Tier 1 and CET1 capital targets, we know it's been discussed that they don't necessarily need to get to their target by 100% before they are exited from conservatorship. In fact, there's scenarios that make more sense for them for the Treasury Department and FHFA to come together, create the plan, and say, this is the roadmap for the next 4 years. And as they grow stronger and continue to rebuild capital, we can lose some of the limitations, perhaps paying a dividend, perhaps the treatment of the preferred stock the junior preferred stock that exists today. And so there are some roadmaps that you could let this open up over a couple of years. There's also the scenario where if they lowered the Tier 1 and CET1 standards to the 2.5 to 3 range, we're actually very close to getting there in the next few years already with modest capital raises. So you don't need to have this big bang anymore like you did 10 years ago where you have to raise hundreds of billions if they're able to modify that to a more reasonable rate. So Ed, I will stop there for a moment, and if you have questions.
Yes, great. Appreciate both of your insights on this. I know this is going to be a hot topic as the Trump administration comes in. Just before we jump into a couple questions, David, can you please poll the audience to see if they want to ask questions and give those instructions?
Absolutely. If you'd like to ask a question at this time, please press the star and 1 keys on your telephone keypad. Keep in mind you can remove yourself from the question queue at any time by pressing star and 2. Again, it is star and 1 to ask a question today.
Excellent. Thank you, David. And so, Tim and Grant, I just, I had Chris Whalen on. He said he thinks 20% chance they get out of conservatorship. Mark Calabria has been going around meeting with folks. Reports are he's talking about 70% of getting out of conservatorship by 2027. I guess what I would pose to you, gentlemen, is what are the perceived obstacles here? Like, what would make Chris more right than Mark, in essence?
I could start with that. I think what would make Chris more right than Mark is if Trump does a complete about-face and deprioritizes privatization of these entities. Because really what this amounts to, it's executive branch leadership. It's what they want to accomplish. I think there's nothing that President Trump would like to do more than to tell the world that he was presided over the most successful reprivatization of a public company in history as part of his commitment to, working class and working people and monetizing that money. So I think that's pretty much the scenario. And how Chris Whalen comes up with a 20% probability, that's like putting a wet finger in the air. There's no basis for that whatsoever. You have to believe, since Collins, this really is a question of priorities. In the conversations that I had with the Biden administration, and Grant and I were talking to people at a very high level, they were inclined to get this done, but they were going to push it into their next term, the next administration. And of course, they didn't get that opportunity. And so at the end of the day, I think everybody's aligned, like I said in my piece, the shareholders, the taxpayers, the entities themselves are all properly aligned towards the solution right now.
And I would just add, Tim, another component that I've seen that, and I think you're right, 20% is maybe a wag guess. There was a recent AEI panel. AEI hosted a housing symposium as part of their annual housing summit. And we had this gentleman, Calhoun, on. Mike Calhoun, he's the president for Center for Responsible Lending. He was once his hat was in the ring for potentially heading the FHFA. Very plugged in. I think he's very objective, and his commentary on that panel, I think, echoes most who have a voice in this scenario right now. And that was, he believes that it will be released during this administration, and that there are leading proposals that just makes more sense as that utility with that utility model with a range of return. You know, they essentially act like utilities, and so why not just call them what they are? You then just get in modestly to how do you want an explicit guarantee or not? And if you do, how do you address that? I think that's really, I think if there's anything that they'll have to address, it's that, and I think it's very addressable. Maybe a standby commitment fee or something that rhymes like that for Treasury. But Mike Calhoun is on board. A lot of them that have this voice are on board. And so that, to me, there's this momentum, and that gets back to one of my comments where there is a consensus, and the ideological roadblocks that occurred years ago are just not there anymore.
Okay. So, but before we open it up to if folks are on the line, you know, I guess Trump has been out campaigning for 2+ years. Housing doesn't really come up. So I guess, are there things that he said or things that people on his team have indicated that make you confident that this is a priority for his administration? Because that's something I always struggle with is, you know, if you talk about immigration and deportation, I know what he wants to do, and tariffs I want to know, but he does not really talk about housing a lot.
I would just answer with a simple yes. There are people that have been very involved in the transition team at all different levels. Actually, Trump's transition team, you know, very confidently started back in March, and they were committed towards doing it privately. And so, you know, for the viewers that may not know this, you know, once you become the nominee of the Republican Democratic Party, you're entitled to transition funding, you know, and so the GAO shows up and says, hey, here's your money, and they didn't take it because they had already been well underway and working on, you know, what they want to accomplish. They have a very, very aggressive agenda in the first 6 months of this year, and bureaucracy is not, you know, in their vocabulary. So I can longer answer, but yes, there are people inside the Trump administration with a lot of influence that have this prioritized as an issue.
Right. Okay. And then how do you, I don't know if you've spoken with Scott Bessent or folks in his circle, but how do you view his selection for Treasury Secretary and the influence that would have on the GSEs being recapped and released?
Why don't you take that, Grant?
Yeah, so what we've heard from the team is they are ready to do what Trump wants to do. And a very big difference between Trump 1 and Trump 2 is that everybody coming into Treasury has been briefed on this already. It's the same theme across the board with Trump 2.0. It's a much more mature transition. So not only are the stakeholders briefing these transition teams, and they're on board with we're ready to go with what Trump wants to do, which I do think was a little bit of a distinction with the last Secretary of Treasury. And second to that, Fannie Mae and Freddie Mac and FHFA all have teams. They have investment bankers that have been taking years now building up plans. And we know that they all have plans ready and in place for an exit. So I think that distinction is very important. So yes, very different than the last. There's a lot more momentum and awareness of the issue. The last thing I would say is to your previous question too. You know, housing may not have polled well, or maybe in the top 3 for the campaign issue, but we know if you look at state polling, it doesn't sit well with homeowners. There's a massive supply shortage, and so the Trump administration is well aware that if they want the economy to run well and they want to make America great again, in the words of President Trump, that they're going to have to address workforce housing and first-time home buyers. The only way to do that is to address Fannie Mae and Freddie Mac. You have to go through them for this.
Fantastic. All right, David, do we have any questions on the line?
We do. We'll take our first question from Neil D'Amato with SIG. Please go ahead. Your line is open.
Great. Thanks a lot for having this call and taking questions. I just was curious if there's names you're hearing or names you'd like to hear to head up FHFA and sort of as a follow-up to that, just sort of how you think about you mentioned the capital rule needing to change to get to something closer like 2.5%. How do you view sort of the timing of that process once someone gets in charge of the FHFA?
As far as candidates, we've heard, Bill Wade, who was, or Bill Pulte with Pulte Homes, Dana Wade, who I believe was a commissioner in FHA under Trump. Really bright young guy that I've spoken to a lot. John Roscoe, who used to be executive, chief of staff for Mark Calabria, very versed on these issues. They're going to bring someone in, I believe, that's, it's not going to have a big learning curve, obviously, in housing and is committed to getting it done. Equally important will be who they choose in Undersecretary of Domestic Finance that will coordinate between FHFA, the entities themselves, the investment bankers, and Treasury. So there's, it's going to take a full team of people to get all that done. Grant, you got a comment?
Yeah, I would say, on your second comment, a modification of the capital rule would likely be easy, quick, and like we've seen in that last amendment, the Treasury can change that with the stroke of a pen. They have the pen on this, and FHFA would, our assumption is they would largely fall in line, and the GSEs publicly have said those are very onerous requirements that they currently have, so they would certainly be amenable to making those changes. So I don't think that's a roadblock, and I think the theme of what Tim picked up is the theme that I previously mentioned. Everybody that they're trying to slot in this transition has awareness and has understanding and has some depth of knowledge that has not occurred in previous FHFA leadership roles or Trump 1. So I think that distinction will carry some weight.
Okay. Do we have any other questions, David?
We'll take our next question from Adam Duckhoff with Everyday Management. Please go ahead. Your line is open.
Hey, Tim and Grant. Thanks for taking the time. My question is regarding the process to make it happen. What are the steps that you need to see, and what would happen first? Is it an executive order, and then a write down, or do you need to get your director? You need to get your FHFA director in place, and then you can move forward. Just want to see how you think about that. Thank you.
Well, I think the executive order from the president, and if what I'm hearing is correct, and if the Trump administration is committed to this, you could see that within the first 90 to 120 days of inauguration, when Treasury Secretary Bessent is in place, and then everything would start based upon Treasury's direction and FHFA's cooperation in achieving the president's executive order. So I think we will see something significant by May of 2025.
Okay. And David, I believe we have one more in line there.
Yes, we do. We'll take our next question from Miles Hammond with Shea. Please go ahead. Your line is open.
Hi, thanks very much. I actually had the same question, was what what are your expectations for news flow in the first 100 days? You mentioned an executive order in 90 to 120 days. So, I'm interested in maybe there are other things that you'd want to see either before that or, what you'd expect subsequent to that, whether it's, the change to capital requirements. And then question sort of two as an addendum to that would be, as you think about executive order versus a consent decree that might be sort of more kind of definitive and more sort of immediate. I mean, how do you think about those two scenarios? I.e., could you see a consent decree that moves it faster, or is your expectation that it will be an executive order and not a consent decree? Thanks very much.
Well, I think the modification of the capital rules, ERCF, would occur once you've got confirmation of the FHFA director. And again, most of that work is done. The stress tests, the different things, they're in really good shape for that. The difference between an executive order and consent decree, a consent decree would come from Treasury and FHFA and the companies. They'd all be parties to that. And that's, there'll be a lot of discussion around that as we move to that point. But the consent decree would follow the executive order.
And Miles, I would just add, I think this is a great question. I think the last two are very similar theme, and it is that important distinction. Reading the tea leaves, if you're looking forward, we'll want to see leadership in place first, and so keep an eye on who's in the seat and what's their background. I think that will tell you quite a bit on the directionality. And then, even like Tim said, by May, there could certainly be some sort of announcement of the plan to exit, not necessarily an immediate exit, of course, but that plan would get in place. And then you could go down the route of, is this a executive order or a consent decree, like Tim mentioned. So certainly in the first 90 to 120 days, there could be some announcements on this, given that most of the work and the heavy lifting is already done. They're just waiting for that pen to get activated with the new administration.
So just to dig into that, when you said you want to see the leadership, presumably you mean like the FHFA secretary and some of the under secretaries. I mean, and you mentioned the background. I mean, what's the best case scenario there? What would you be more worried about? What specifically are we looking for? Is it sort of former capital markets guys, or what would be good? What would be bad for that?
Well, I would say, Tim, and you can feel free to weigh in on this, but my assessment is the three candidates that Tim named are all really great candidates for this. For instance, John Roscoe had been there on the first round. He was helping and assisting in writing some of these exits. That's our understanding. And so you have that momentum already of some of this institutional knowledge on the direction that we'd like to see as shareholders, and frankly, it's aligned with the taxpayers. So what's good for us is good for the taxpayers, and I think all three of those candidates are in that camp. So it would be candidates outside of that may we may not have heard yet. Could change that. But Tim, what do you think?
I agree, Grant. I think that, and a lot of this is being driven by conversations around the water cooler too. The former CEOs, the former CFOs of Fannie and Freddie, they all have strong opinions. The current CEO of Fannie Mae has strong opinions about, them exiting conservatorship. I think the surprise this time will be how anxious people are to move this forward and get it done. It's really a shame that it's lasted this long, and it's cost the American people, and it continues to cost them in many, many different ways to to continue this conservatorship any longer.
Cool. Thank you very much.
Okay. And then we did get an inbound on the email discussing, and I was going to address this in a little bit anyway, is, and I'll just start it the way I want to start. There's some folks out there saying, you can't take the GSEs out of conservatorship. If you do, mortgage rates are going to go up 50 to 100 basis points. It's going to really negatively affect the housing market and so on. And so I guess, what is your gentleman's view on that? What do you anticipate? And I think Grant, you mentioned, the explicit versus implicit. And I have another question on that, and I think we can wrap it up. But let's just give your first initial take on mortgage rates and the impact exiting would have on those.
Well, my view on after. Yeah, go ahead, Tim.
No, you first, Grant. You first.
Yeah, I would say after looking at this from the model perspective and hearing, studying people that are much smarter than me in housing finance, is that implicit versus explicit does matter, and there's an easy solution to ensure that the market is comfortable with some sort of treasury and government backstop. That's likely through a standby commitment fee. That's marginal, but there's actually many scenarios that if you can cross that hurdle and allow these businesses to capitalize to the 2.5% to 3% range, and then have a standby commitment fee that'll likely not ever be touched. There's scenarios where the spread on the mortgage rate actually drops relative to the 10-year. It's wider than it should be right now. We'd like to see about a 150 basis point spread. That's blown out in the past couple of years. So there's actually scenarios where you can calm the market, and that is actually my base case. Is you get to that point where we're in this sort of standby mode where they're stuck in conservatorship, and just people talking about this spooks the market. If you can get through it and get through it with adults, then you're on the other side of this in a much better, clearer place.
Fantastic.
I agree. That would.
Go ahead. Go ahead.
I just add one thing. I mean, the idea of an explicit guarantee, the people that mention that are the ones that want to keep them in conservatorship, because it's never going to happen. We don't want $7.2 trillion worth of additional liabilities on the books of the federal government. It's unnecessary. It's as unnecessary as having an explicit guarantee for J.P. Morgan. And Fannie and Freddie, once everything's peeled back, they're as strong financially as any financial institution in this country. So the need for an explicit guarantee is just not there. And it's a stall tactic that has been one of the favorites, of trying to keep them in conservatorship and the status quo.
Singing to the choir there, Tim, because I sit here and I look, if we look at Dodd-Frank and the changes that were made to, first of all, the GSEs do not do any private label MBS anymore. Underwriting has improved. There's none of the no income, no asset verification. It's all full doc underwriting. And to boot, we went and enhanced appraisal standards fairly significantly. And I think we have, at this point, you can pick your spot. You want to start in 2014, you want to start in 2018, but you now have multiple books that have seasoned and have a very good idea of what the credit cycle looks like for those books.
Absolutely.
We're getting to the top of the hour, so I think that was good. David, do we have any more questions online?
We do. We have a follow-up question from Adam Dugoff with Everyday Management. Please go ahead.
Okay, and I think Adam will take your question, and I think after that we're going to end this call. So, Adam, please.
Thank you. Just following up on that implicit versus explicit discussion, is there any chance if they put the standby commitment in place that they would roll the TCCA fee to 10 basis points to serve as that fee, or you'd have an additional fee come in? And just trying to think about how that impacts the returns to the companies and to shareholders. Thanks, guys.
The periodic commitment fee or standby commitment fee, they've already done a lot of work on that and came out in the litigation. It's modest. Do you remember how what was it in terms of a basis point charge, Grant? It was very, very modest.
It was modest. Yeah, it was modest. You could say it's an equivalency to that TCCA.
Yeah, and not impactful to their bottom line in a big way. And it wouldn't increase. It would be cheaper for them to have a periodic commitment fee with a backstop line of credit from the federal government than to hold the equivalent amount of capital on their books. They'd be grossly overcapitalized at that point. They'd have more capital than any financial institution in the United States. So it's a relatively easy thing to do as part of creating the security that the financial markets want, that these entities are stable and they can invest with confidence.
And Adam, I would just add, I think the TCCA fee that stands today likely will continue to stand. That's a law signed, and that they'd likely not have to touch that. But a standby commitment fee would be modest, as we mentioned. So I think you could run both and not materially affect the mortgage rates at the cost to the end consumer.
And the big thing is to make sure that TCCA fee is not renewed. That was Mark
Correct.
Warner slipping a Mickey into the whole process, and it puts a burden on homeowners, first-time homeowners. It's a terrible tax on homeowners.
Yeah, let that sunset would be the best solution.
Agreed. Thank you.
Can I ask you, Treasury has lines of credits, right, from HERA that neither one has used the full. I can't recall if it's $250 each or what have you. When you talk about a standby line of credit, do you think that those lines would count for that?
Yes, I think they have authority on that through HERA.
Okay.
Agreed.
Gentlemen, if you have any closing comments, love to hear it. Otherwise, I think this was a great call, and I appreciate your time and insights.
Grant, you first.
Well, thank you, everyone, for being on the call. I do think this is one of the more timely, both from a trading perspective and just from an American excellence perspective, being one of the only countries in the world having this 30-year fixed rate mortgage and having this mortgage system. So maybe we can finally get this last piece that's been unaddressed from the Great Recession done, and look forward to staying engaged with everybody. If anybody has comments or questions, feel free to reach out to Ed, and we'll keep the dialogue going.
Yeah, agreed. And thank everybody for being on the call. Enjoy the holidays. There's light at the end of this tunnel, and it's not another train. Pretty sure about that. So thank you. Thank you again, Ed and Compass Point for hosting.
Sure. Thank you, Tim. Thank you, Grant. And thank you, David, for running this call. Everybody have a nice day and enjoy your weekend.